Hi, good morning. Uh, so let's start. Uh, Good morning, everyone. So thank you all for joining on this Saturday morning. So uh, the topic for today's webinar is building the corpus you actually need. So corpus in the sense it can be any corpus that you want for your future. It may be your retirement corpus, or it may be your kids' education corpus, or it may be your kids' wedding, marriage, or your house building corpus. Or this corpus can even be, combined. But each of these are goals, and for each of these goals, you'll be having a specific time horizon with a specific amount that you would actually need for each of these goals. So in this webinar, we'll just cover, how you can, uh, make organized track on, how you are going to achieve this goal and what you can do for it. Because generally, if we ask a person what is their retirement amount that they actually need, they'll just give a random number. They'll just think of you know their monthly expenses, and they'll just multiply it into 12, and then they'll multiply that amount with 25 or 30, because they would be needing that amount for the next 25, 30 years after their retirement, right? But a lot of people, they generally don't account inflation, or they don't follow any rule on how much withdrawal they need, and they don't account where which investments they'll be investing, which the corpus they've created. So we have to be organized in terms of what corpus you want to achieve, how you will be achieving, and what you need to do after you achieve that corpus, so that you have that corpus in a safe manner, and you also get a monthly cash flow out of it. So we'll be seeing what we discussed so far in this webinar in a detailed manner. So, like I said, these are the things which we'll be covering today. So, the first one is like, you shouldn't have an approach where just guess a number and you just you work on that number. So it doesn't work like that. You have to be very organized in terms of creating a plan. And we'll also see the 6-step framework on how you can create this plan. And we'll also see how we can account inflation, because a thing you buy for 100 rupees today definitely wouldn't have been 100 rupees 10 years back, or it won't be 100 rupees, the same 100 rupees 10 years from now. So we have to account inflation every time when we are calculating our corpus. And we should also need to backtest this number with a lower return, because we don't know how market will give returns, right? Because nobody can predict the market. So we also have to have a worst case scenario plan as well. And we can uh, do a backward integration, and we can just calculate on how much SIP we need to do to achieve the goal, the corpus you need to create. And we'll also see like what are the common mistakes we see in the end. So now let's get into the webinar. So like I said, like, you can't have a random number. Like, it just can't be a feeling. I just need so and so crores or anything, because like, you need to have a clear path and a runway on how you need to achieve this goal, and based on your cash flows and based on your requirements, so that it is tailor made for you. So generally, you need to, like, start with your goal and time horizon for each of these goals. And you need to account for inflation, and you need to have a realistic return assumption, so that you can't, create a plan using saying that I'll be doing 20-30K SIP, and the returns I'll be getting every year will be 15-20%. You can't do it like that, because getting 15 to 20% return, will be 15 to 20% return will come, but it won't come for consistently. You need to do a lot of homework for it to achieve that kind of returns, right? Because when we invest in a very safe investment products, they generally tend to give around 12 to 13%. And if you want a even more conservative uh, uh, approach, you can even take 10 to 11% return assumption as well. And you need to, have a safe withdrawal rate. There is a rule of four, right? Let's say, for example, if you do a 4% withdrawal every rate, 4% withdrawal every year, then definitely you won't, exhaust your corpus, right? So you can't take 10 to 15% of your corpus every year. Then you'll easily, exhaust your corpus within a very few years. And also, like I said, we need to stress test it. So we need to have a worst case scenario plan as well. So this is the 6-step method which you can use to create a plan for this, on how you can know how much corpus you need to achieve, right? So first you need to like write down your goal, each and every goal that you want to build. It may be your retirement, your kids education, your kids marriage, your house building, be it buying a car or travel and anything. And you need to put a time horizon for it. Let's say, for example, your retirement may be 15-20 years from now, or 20-25 years from now, and your kids education may be 15 years from now, and maybe your car purchase can be 2 years from now, and a travel can be 1 year from now, and your house building can be like 7 or 8 years from now. So each and every goal has this different time horizon and a different amount, right? So like I said, for each and every time horizon you need to apply a certain investment, and based on a certain asset class. You can't definitely go and invest in equities for a shorter time horizon goal, be it travel or your car purchase. You definitely can't invest in full equity product, because equity are a volatile asset class, right? You don't get returns within the first 2 years, or even if you get it, like at that, let's say, for example, during the end of your goal where you're going to take out that money, and if the market crashes by 10 or 20%, you definitely will be on a shortfall, right? So definitely you can't take that risk. So for a shorter time horizon, you definitely need to invest in a very safe investment asset class like a debt, an FD, or a short-term debt mutual funds, right? Fixed income, basically. But for a long-term time horizon, like let's say at least 7 years plus, definitely you can invest fully in equity, right? And even in terms of equity, like if you're completely, do your own research, and if you're a complete fully trained DIY investor, maybe you can take on that risk. But even if you have these goals, and these are very long term goals, and if you want the equity and make use of the equity returns which are quite good, then definitely you can approach wealth management companies like us, where we'll help you invest your help you manage your investments, and we'll make sure that you achieve these goals, right? And we can even create a plan for you as well, a customized plan based on analyzing your cash flows, your income, your assets, liabilities, and your goals. And like I said, most of them don't adjust for inflation. Like let's say, for example, your monthly expenses can be 30,000 every month, but definitely it won't be the same 30,000 after a few years, right? Because uh, everything's are the rate at which you're buying won't be the same forever. So definitely we need to account for inflation, and generally our country's inflation is somewhere between 6% to 7%. So you can take this number, and for health and education, generally the number tends to be higher, and it can even be 10-15% every year. And one more thing is, we need to set our assumptions, the goal number, based on our cash flows, based on our potential, because it needs to be realistic. Because we can only achieve the goal based on our cash flows and our existing investments. So it needs to be realistic, and also we need to like uh, back calculate the corpus, so that like we'll know how much your monthly expenses will be, and we'll get to know how much investment you need to do per month. So these are the process which we'll be following. So the first one is like we need to define the goal and the time horizon. So we need to get to know about what's the correct goal which which you're going to set, uh, whether it's going to be retirement or your kids education, or based on that we need to work on what the annual expenses today will be, and we should account for inflation, and we need to get to know on what the time horizon will be, right? So, like I said, we need to account inflation. Let's say a monthly expense of 60,000 will be, every year if you just compound that 60,000 at 6%, after 25 years, the same 60,000 expense will be 2.58 lakhs, right? So this is why you should always account for inflation when you're going to create a plan. And and another important thing is that generally a lot of people, they don't see the real return. Real return or nominal returns, that's two difference because generally your assets, your investments needs to grow somewhere more than your inflation rate. Then only you're making the real returns, or else inflation is just eating away your investments. Like at least when you're going to invest in an FD or a real estate or gold, somewhere the returns are somewhere between 7 to 9%. By investing in these asset classes, you're just preserving your wealth. It just grows in the value, but still the real returns, it's not growing. So the real return is what the formula is, the return minus inflation. That's the real return, right? So let's say for equities, generally in the last 3 decades, it has grown somewhere between 12%. So when you account inflation at 6%, the real return is 6%, right? So you're growing 6% above than the inflation rate. Whereas when you take debt, fixed income, FDs or gold, your real return is only 1 or 2%, right? Which is very minimal. So that's why, in terms of wealth creation for a longer period of time, equity is the best asset class. So you should always consider equity when you're trying to build a retirement corpus or a long-term corpus. And generally, you can back calculate this corpus. Like I said, the corpus needed can be, the formula is your future annual expenses divided by the withdrawal rate. Let's say, for example, like we saw in the last slide, right? Let's say your future annual expenses after 25 years is, let's say, 2.58 lakhs. Generally, per year, the annual expenses would be somewhere between 30 to 31 lakhs. When you divide this number by 4% or 5%, you'll get the corpus would be around $1 million, which would be around 8 crores, right? So the corpus you want should be 8 crores. So this is another example. Like let's say, for example, you're currently 35 years of age and your retirement uh, year 60, you have around 25 years of timeline, right? And let's say your monthly expenses currently 60,000 and the inflation rate is 6%, then you have 25 years. Like you will actually be needing 6.11 crores. And with this, uh, like with the 5% withdrawal rate, you'll be able to comfortably withdraw 2.58 lakhs from there on, after from your 60 years of age. And generally, you can't take uh, a same amount as SAP because obviously when you're growing in your career, you actually need to, step up your SAP. As your income grows, your savings also grows. So it's better that you step up. And with the step up amount to achieve this 6.1 crore corpus, like let's say every year you can start with 19,934. And every year, if you're compounding and you're stepping up at 8%, right, you can actually achieve this goal in 25 years. But let's say, for example, you're actually not, uh, stepping up your SIP, then you need to somewhere do a double the amount of 38,000 for the next 25 years in order to achieve the 6.1 corpus. And the returns that you've taken is 11%. But generally, like let's say, for example, uh, you know, uh, like equity returns won't be the same every year, even though they compound at 10 to 12%, but you need to wait for at least 5 or 10 years so that you can see that that is the compounding rate. Let's say, for example, you started your investments at 2024. Definitely, in the last 2 or 2.5 years, your compounding rate would be less than 10%. And in most cases, it can even be uh, lower than your FD rate. So you might even think, I've taken the a compounding rate at 11%, 12%, but why is it not compounding? Because equity is not, kind of a investment which gives consistent returns, guaranteed returns like an FD. So you need to give that long time horizon, at least 5 to 7 years, so that you see the returns in your portfolio. So, it's better that, if you need to, have a worst case scenario plan, like I was mentioning. Let's say even, in years, if the returns go down by 2%, you actually need to increase your SIP amount by almost 40%. Let's say, like I was saying, if some of the investments which you're going to make are not yielding returns, after even let's say after 7 or 8 years, then you actually need to start uh, upping your investment money, because then only you can achieve your goal of 6.1 crore, right? And another important thing is where your investments are. That is the asset class which you'll be investing. And earlier, let's say you're around in your 30s or 35s, generally you can even go and invest almost 80% of your investments to equity asset class, and maybe 20% can be towards debt fixed income investments. But let's say, for example, uh, even in your early years, if you're completely covered based on your emergency funds, health insurance, and if you're completely living in a known house, then you can even do 100% equities, definitely. But as and when you start, keep growing older, and as and when you're keep nearing your retirement age, or you're keep coming to your goals, it's better to, start, moving your asset allocation percentage, because as and when you keep coming near your goals, you actually need that amount, right? At that time when the market corrects by 10%, it will be a huge amount. Let's say, for example, when you're near your goal, almost at 58 or with the late 50s, and you're somewhere between 5 crore corpus, a 10% correction would be almost minus 50 lakhs, right? And in your case, when you're doing a 38K amount SIP, that can be even your 5 year to 10 year amount of investment corpus when the market corrects. So that's why it's generally better to, like move your investments to a safer haven when you're near your goals. And after, you achieve the goals, it can even be 80% towards fixed income and 20% towards equity. And these are the some of the common investment uh, mistakes that we investors make when we are creating a plan. The first one is, as I said, picking a round number just straight off a feeling, and not just calculating based on your goals or based out of your cash flows. It should be a realistic number. And the second mistake is, we're not accounting inflation, right? Because after 25, 30 years, things won't be the same like now. And, so that the inflation shouldn't eat out your corpus as well, right? So you need to account for inflation based on your future expenses, and you should also make sure to account the real return and invest in a good investment, so that inflation doesn't eat your investment corpus. And another thing is, like, you can't assume like higher returns of 15-20% and create a plan, because in a bull market things would go good, but in a bear market things won't be the same. So taking an average realistic number somewhere between 10 to 12% would work. And you can't, you know, create a plan with only 4 or 5% withdrawal rate. Let's say, for example, in between some emergency might arise, or in between you would need a large amount of money. At that time, we need to completely rework your plan, right? So you can't use, one withdrawal number forever. And like, the asset allocation which you're doing should be right based on the time horizon, right? You can't be completely staying invested in equity, and you can't try to achieve those goals. And you should always, create a worst case plan, and you need to stress test whether this plan will work out or not. So I just also want to, like give checklist on what we'll just, this is just a summary on how you should do it. This is just a checklist. So like I said, you should write down your goals and the current expenses and the time horizon which you will be needing for these goals. And you should account for inflation based on today's expenses, and you should see the future value and the future expenses which you will be incurring in the future. And you need to have a withdrawal rate of 4 to 5%. And when you exceed this, generally there's a higher chance of you, exhausting your corpus. And another thing is, to calculate the corpus you actually want, you can just divide the future expenses divided by withdrawal rate. And you can, reverse engineer your SIPs to each of these goals, and you can see whether you will be achieving these goals in the correct time horizon. And you can actually see whether you're, currently on track or under shortfall. And like you need to start de-risking your portfolio by stepping down your equity exposure and stepping up your debt fixed income exposure, so that your corpus don't get eroded because of market corrections. And finally, like you need to rerun your numbers based on a -2% return, so that you actually can see whether you should increase your investment amounts or not. So this is that's all from my end. And lastly, I just want to inform you that we actually have two investment services, right? The M2W, which is for the mutual fund investors, and the PMS service, which we do it for our equity investors who want to build an equity portfolio. So be it M2W or PMS, we both of the investors have a goal, right? For M2W investors, the goal is at least to create a 1 crore corpus, right? And for PMS investors, generally, like the goal is to create at least $1 million, because they're already starting with a 50 lakh portfolio. And if the with further market contribution whenever there is a market correction, and with at least giving a 2 cycle time, you can actually achieve that. So here, be it MPW or PMS, the goal is to create a a certain corpus, right? So each and every client will have a different uh, cash flows, different needs. So for each and every one, it's better to create a financial plan based on their requirements. Because like after you achieve 1 crore, the MPW client may even want to achieve a bigger number than that. And even for a PMS client, let's say for example, they want to achieve uh, a $5 million corpus, or within this $1 million, they need two or three goals which we need to be accomplished. Then they need a certain goal, a certain plan on how they need to plan for it, right? So it's better to have a financial plan for each and every one, and we can completely help you to create your financial plan. So it's very simple. Like I said, we'll almost follow the same process. We'll try to understand your overall investments, your asset class investments, and we'll try to understand your liabilities, and we'll try to understand your cash flows, and we'll try to understand your expenses, and we'll also get to know about your each and every goal, the time horizon, and the value amount. And based on this, we'll create the financial plan. And we'll also be sharing you an Excel sheet on, to get the data of your, like I said, the goal, the time horizon, the goal value, your cash flows, income, expenses, your investments. And, we can even, map these existing investments so that they grow at a certain percent, and these investments can actually be uh, mapped towards these goals which you have mentioned. So we can even do a goal mapping for you, and we can even help you create a calculation on how you can achieve this 1 crore, be it an M2W client, or how you can achieve this MDM, $1 million milestone of 8 to 9 crore. So we can help you on those things if you're already a client of iThought. To achieve the $1 million What is the average investment goal from your observation? Hmm. It depends on like what time horizon you have, sir. Like I can easily say, like like you can, if you can do a 3 lakh SIP, you can easily achieve with that goal within 12 years time. But we need to understand whether if you can actually do 3 lakh per month, or whether you actually can have a time horizon of only 15 years, or for 10 to 15 years. So we need to understand your cash flow, your savings, and also we need to understand what is the time horizon that you actually want. And we can also if you have an existing investment already, then it's better, because these existing investments will also be keep growing, right? So then the chances of you achieving this $1 million milestone would be even more faster. So it's better to connect with you personally, and we can work out a plan. Yeah. What is the average percentage growth in MF per year? uh, the Nifty has delivered between 12% return in the last 3 decades. So having a assumption rate of 12% would be decent. It's not very higher, or it's not very lower. So having a assumption or an expected rate of 12% is fair, sir. Yeah. But like generally, index funds tend to deliver this rate of return, and we generally want to achieve more than this, and that's why the very reason of mutual funds, the active mutual funds exist, because each and every fund manager's main role is to outperform this index. So if we tend to invest in a good quality mutual fund or a good quality equity portfolio, the chances of achieving an extra alpha of 3 or 4% is very much possible. But you need to give a time horizon of at least 5 to 7 years, because that's how long it takes for a cycle to play out. Okay. Thank you all for joining on a Saturday weekend. uh, have a nice weekend. Thank you. Bye.